Hello and welcome, everybody. Really excited to be able to host this virtual session today. My name is Julius Lang. I will be representing the Helvetian Investment Club today, the largest student-run finance society of Switzerland, based here at the University of St. Gallen. With me today, I have two very, very special guests. We're incredibly honored to have you both here with a value investing background. Still, we did not want to focus or at least limit ourselves to investing today. We believe that there lies great value to be picked up in this session today beyond investing. So usually in our live sessions, we now have a warm applause. I sure hope my little intro will do. Thank you very much, Monish Fabrai and Guy Spear, for being here with me today.
It's a pleasure,
Julius,
Julius.
it's our pleasure to be with you.
So maybe starting it off still, as I said, we don't want to limit ourselves to investing, but let's kick it off since it's the in our same denominator for that matter. Monish, you in a previous interview you said you started out investing in '95, and one of the four stocks that you initially picked turned out to be a 140 bagger, if I remember correctly. So why don't you tell us to maybe get everybody on board here? What is it that is so great about value investing? Why do you do it, and why do you keep doing it?
Yeah, well, Julius, it's a pleasure to be here and with all of you. I haven't done this type of a format before, so it's always fun to expand my horizons, which is wonderful. Yeah, in '95, I ran to this company in India. I was looking to I was managing about $1 million, and I wanted to just step my toe into India a little bit. What I actually should have done in hindsight should have been a lot more than just a toe. But I put $20,000 of that 1 million into Indian equities, and at that time it was very cumbersome to actually open an account and trade and all that. But anyway, I got all that done, and there was a company, Satyam Computer Services. I was in the IT business at the time, and I knew these guys because their sales guys would meet me and want to do business together and whatever else. And I liked the company. I admired some of the people and such. And I was surprised that when I looked at the business in '95, this was a company that was growing probably 60-70% a year, and it was going to be doing that for quite a while. And the market cap of the business was less than the value of their real estate in Hyderabad. So basically, you were buying it below, real book value, significantly below that, and no one was, concerned about the earning stream, which was very significant. And so I had no idea how big this business would get or what type of return I would get. What I decided to do, at that time, India did not have DMAT. So I got these kind of very flimsy stock certificates in my home in Chicago after I bought, and they're like kind of falling apart, whatever else. And I basically stuck them in the bottom of my desk drawer. And I said, okay, we don't need to really open this drawer pretty much forever, just kind of because these are good businesses and we just let them do their thing and so on. And so that's kind of what I focused on. And it then we had the dot-com bubble and then the dot-com bust. So Satyam had spun out a dot-com company, and then from mid '99 onwards, the stock started going crazy. And I think in January, February of 2020, I decided to take a look at the business again in terms of the valuation, because it had gone up over 100x, and I couldn't make head or tail of those numbers. I mean, I think it was deep in bubble territory. And the 10,000, I had put half the bet in India into Satyam. So 10,000 that I put in was sitting at about like 1.3, 1.4 million. And the Indian government theoretically had told me that I could repatriate it all back. And India has a lot of exchange control. So I didn't have a lot of confidence in what they were saying. So I said, I wonder if they'll let me, take the 1.4 million out just like that. And so I gave the sell order, and then I also told them to wire the funds. And the next day, the funds were with me, and it all went very smoothly. So that was that. And then the stock dropped, I think, 70% or so in the next 18 months when it came down to more rational valuations.
No,
And
amazing.
had some controversy much later when they started cooking their books, etc. It wasn't a situation that was prevalent in the company in the duration that I owned it. That started really several years after I had exited.
Amazing. I mean, highlighting our very special setup today. As I previously mentioned, our esteemed previous guest Guy is with us as well. Guy, having known Monish for a long time, and having mentioned one example of a great investment, what do you believe, Guy, Monish to make distinguish from other value investors, and what is it actually that makes a great value investor?
You know, Julius, there's only one person whom I've now introduced to Monish that I won't name here because I don't have his permission, that has as unusual mind as Monish does. And there are so many circumstances, including what I described in the Buffett lunch, where he took a set of facts that was available for everyone, but saw them in a completely different way and arranged them in a different way. And just to give you very briefly, it's an example of how Monish thinks differently. I meet him for breakfast at the Mandarin Oriental Hotel with a view over the park. And he says, you know, I'm going to bid again on the lunch with Buffett. Would you like to join me? Something like that. And I kind of respond to him with what a stupid idea. And within 5 minutes, he explained to me why it was not a stupid idea. And I completely adopted the thinking. So what makes Monish an unusual investor is that capacity to take the same set of facts and arrange them very differently in his mind and see something different to what other people see. Exactly where that comes from, I have no idea. I think that's maybe some combination of genetics and unusual upbringing. And it's not really clear to me. That's what makes Monish do these unusual investments, and that's what makes people follow him. And it's great that I have a front row seat. I get to learn every time we discuss stuff. And the only thing that I've managed to do with Monish is that, you know, I often am not convinced by him, and I hold on to my views, which I think he quite enjoys when we end up having the debates. But and I think that probably in the audience, I think there are two things. One is acknowledge when somebody in your life has that kind of mindset and learn from them. There's nothing wrong with acknowledging in oneself that one doesn't have that mindset, and then figure out the people who do and get around them. You know, I even have discovered that when it comes to writing, there are specializations. Some people are good at editing. Some people are good at authoring, for example. When it comes to investment research and analysis, there are different people who have different strengths. You want to get yourself around people who complement your strengths.
Surely, definitely agree. And I mean, speaking of great mindsets, you already mentioned the joint lunch with Mr. Buffett back in the time. Wondered if I understood correctly, Guy, you were interested in doing a second lunch after that? Why was that?
A second lunch with Warren.
So, but yeah, my question was rather, I mean, I know that Monish a introduction to Charlie Munger developed from the lunch with Mr. Buffett. What was the motivation to do a second lunch with Mr. Buffett?
I'm not sure that we did a second lunch. I think that we went multiple times to the Buffett brunch on Sundays after the Berkshire meeting, and Monish he can talk about. You know, they lived in the same state. Not exactly. They both love bridge. They both have similar minds. Not exactly clear to me, but that is now a private friendship with Monish. I mean, if you want me to riff on that, the one thing that I mean, I feel like I have a front row seat on that friendship. I think there's enormous learning that's happened for Monish through that friendship. I think I've learned through having a front row seat. And I've shared some of those ideas, I think, even with the St. Gallen group, this idea that some of the most kind and generous people develop quite a gruff exterior because they have so many people coming at them. And some of the most useless people that you don't want to be around have these incredibly seductive exteriors, which I kind of learned that lesson with the front row seat between Monish and Charlie. But I don't know. Warren can speak. I'm sorry, Monish can speak to his relationship to Charlie better than I can.
That'd be really interesting. As we've said, great mindsets in both Charlie as well as Warren. Monish, how do they differ on a maybe as personal basis as you want to go into? What makes them individually succeed?
Yeah, I'll just take a little detour before I answer your question. So, I've talked about before that cloning is a great mental model. Another great mental models is doing things which have asymmetry, and doing things where downside is muted or non-existent, and upside is unknown. And in fact, if you look at a person like Jeff Bezos or Amazon, that's what they do. They basically throw a lot of stuff against the wall. They're all relatively small bets. Most of them don't work, but a few do. And then when they do, you get huge payoffs. And we see that investing too. Like for example, we talked about my Satyam investment, right? So the 10,000 not working out was like 1% of my portfolio at the time. And with the Buffett lunch, actually, I didn't really think about it at that time in terms of asymmetry. But in looking back, that makes sense. But basically, I think in 2007, my net worth was over 80 million. Much of it attributed, almost all of it attributed to following Buffett and Munger and Graham's approach to investing. So in effect, I had lifted their intellectual property, and I felt like there was a tuition bill due. So I thought to myself, well, what's a reasonable tuition bill to pay? I said, well, couple of million is definitely within the realm. It's just 2.5% or whatever of the net worth. So my only desire with the lunch was to look Mr. Buffett in the eye and just thank him for everything he had done for me, not just in terms of investing, but both him and Charlie have so many principles that will lead you to be a better human being and such. And of course the lunch, we got it for a lot less than 2 million, and Guy pitched in a third, so it actually was 400 odd thousand for me, which was uh, perfectly fine sum. And then it was buy one and get infinite free, because that lunch led to a friendship with Warren. It led to an even deeper friendship with Charlie. It led to a friendship with Warren's assistant Debbie, which continues to this day for both Guy and me. And it just led to, and Charlie, I met Charlie's friends over the years. I played a lot of bridge with Charlie and his friends, and the quality of those individuals is so high. And I endeavored to make them my friends. So a bunch of Charlie's friends have become my friends, which so when I look back on the lunch and what it led to, none of this was planned. The plan was just to thank Mr. Buffett, and that would be the end of it. And this repeatedly happens in life. Like for example, when I started my first business, I took 70,000 in credit card debt, and 30,000 emptied out my retirement account. The downside was just the 30,000. 70,000 would get wiped out in bankruptcy, but the upside was millions. And so there was, and if it didn't work, I could just go back to a job or whatever, and that worked, and it made me independently wealthy and all of that. So also, for example, in the last few years, I bought an insurance company. I raised a bunch of money, and of course, we've now returned most of it. That's a bet that didn't work. But again, even if it doesn't work, there's no downside. It was basically we were where we started, and we didn't really lose anything. So basically, when I look back at a number of endeavors, I think the combination of cloning and asymmetry, anytime you can identify asymmetry in some action or something that you could take, you should go for it. So, for example, Charlie told me, and I've seen it with him, is he likes to introduce randomness into his life. So sometimes when I'll meet him, from his coat pocket, he'll remove a bunch of letters he's received from people all over the world. There's a lot of people who write to him and whatever. And he'll go through a few letters and say, okay, this one, I'm going to have breakfast with this person. I'm just thinking, that guy's going to fall off his chair when someone from, Charlie's assistant contacts him or something. But Charlie likes that randomness. It has led to many great friendships and in some cases business partnerships for him. And again, there's no downside. And so, I moved to Austin, and what I do in Austin is at least a couple of times a month, I make incredible Assam tea. And a couple of times a month, I invite people I don't know over for afternoon tea. In fact, there's a person coming tomorrow who I've never met. He kind of lives in Monaco, and he's got some apartments and stuff he owns here in Austin, and he's visiting. And he asked if I could meet him. I have no idea how that meeting's going to go or what's going to happen. But if it's not going so well, then the tea won't go for so long. And on the other hand, the last guy I met for tea, I think was amazing. I mean, I think I'm meeting him again this Friday, and it's incredible. So I think this the asymmetry and cloning, I cloned the randomness from Charlie, has a lot of benefits. And the friendship with Charlie, I always think when I meet Charlie, he's finally going to figure out one day the emperor has no clothes. He's going to figure out I'm a total fraud and whatever, and that'll be the end of my my meetings with Charlie. And so far, surprisingly, that hasn't happened. And I told Charlie when I was moving to Austin, I said, listen, Charlie, just ignore the fact that I'm not in town. Anytime, you're twiddling your thumbs for dinner, you can just call me and I can take a Southwest flight over, and it's easy. And since I moved about 8-9 months ago, I think I've met him 3 times, twice for dinner and once July for the harbor cruise in Santa Barbara with his family, which was really special, on his catamaran that he designed. Anyway, like I said, I think that it's led to so many things, and I think I should do more. I don't do enough with asymmetry. I think Amazon does an awesome job with asymmetry. I think Tencent does an awesome job with asymmetry. I think Facebook does a terrible job with asymmetry. So the difference between Amazon and Facebook, even though you didn't ask, is the two Jeffs throw a lot of stuff against the wall, and basically most stuff doesn't work, but it's small bets. And at Meta, there's a massive multi-billion single bet, and good luck with that. That kind of violates the rules.
So I'm definitely sure that there will be a lot of people drafting letters right now to you. Maybe someone will be lucky enough to have coffee or tea with you. You mentioned how developing a circle around you, which is even might be more wise, or has to be more wise to actually pick up stuff. Still, your day to day, or at least I imagine it to be, as a investor, is not. It does not involve as much teamwork, and usually at university we are nurtured this mindset of that teamwork works, and as a team you can achieve great stuff. What has allowed you to achieve all this greatness by yourself? Is it your personality that's set up to work alone, or is it even working alone?
Well, a team is going to have difficulty getting to consensus on stuff that's distressed or hated or unloved. So I'll give you an example, right? I mean, I started visiting Turkey 4 years ago, and I don't know how many of my friends, including one I'm looking at right now, I've talked about the great merits of looking at Turkey, because basically everyone and their brother exited, and the valuations, and there were some great businesses with great management and great moats and such. And I've talked to so many people I admire, and no one's interested, right? I mean, I talked to Charlie about it, and he said, I'm not interested, right? And so, and of course, Guy is not interested, and the thing is, so I think the problem with the team is that if I were in a team with you, Julius, and your friends, and I brought up, this great company I found in Turkey, and we had to make investments by consensus, it'd be really hard to get to consensus. And so that's why I don't believe investing is a team sport. And I think that what ends up happening if you're doing it as a team is, you don't get fired for buying IBM. At least you used to not get fired for buying IBM. So it's these businesses which are non-controversial, great businesses, great moats, and also at ridiculous valuations that everyone is comfortable with, and that's where you end up. So I have some skepticism of teams in investing. I think you can have an analyst and you can have some people help you. That's okay, but it needs to be a dictatorship.
Sure. So having considered that you do it alone, what is it that you do, especially thinking of, well, now in an era of abrupt technological change, what is it that allows you, or how do you actually pick out companies which you believe to have a great payoff in the future? Is there something, especially considering the change in type of companies, that allows you to see these signs more clearly?
Yeah, I mean, I think again, it was a combination of the two models of cloning and asymmetry. So there's a guy from Turkey who came to my annual meeting many years ago. He's a fund manager there. A very high quality guy. I liked him a lot, and I was seeing different things going on in Turkey. So I told him, listen, would you mind if I came to Istanbul and we just visited every business in your portfolio? And I had nothing else in mind other than doing that. I had no plans to invest in Turkey. It was one of those asymmetric things in the sense like, what's the downside? There's an airfare and a few days in a great city, and a good guy. I knew he was a high quality person, and he said, "Oh yeah, this would be a lot of fun." And I spent a week visiting. So the Turkish market had already been through one filter, in the sense that I told him I don't want to visit any companies that he doesn't actually have an investment in, right? So it was already businesses that had gone through his filter, and he'd put real money against them. And then I did it again the next year, and I'm going to, I've done it several times, and I'm going to again do it in March next year, and such. So I think that I think that's kind of a good way to think about it. Is the combination of asymmetry and cloning, two great mental models kind of intersecting, is great.
So this all concerns public markets. When did you realize that public markets were especially interesting for you, and then why are they still? Have you ever thought about incorporating other asset classes into your portfolio?
Yeah, the public markets are unique, and I think one of the things that they have to offer that is not available in other markets or asset classes is that you're not doing negotiated transactions. So these are auction-driven markets which are subject to fear and greed. And so, for example, I mean, let's say I look at some apartment in the city center Zurich, nice 2-bedroom apartment, and let's say it's available for, I don't know what the price is. Let's say it's available for 1.5 million. And every day I ask a realtor friend of mine, hey, can you tell me the price of that apartment now? He would say the next day, yeah, it's 1.5 million still. And then the day after, he would say, listen, dummy, it's still 1.5 million. And if I kept doing it every day, he kept humoring me by giving me the current price. That price would probably range from between, say, 1.5 to maybe a max of 1.7 million in a year, maybe 10% or so movement in that 1 year. if I throw a dart at any random stock on the New York Stock Exchange, and I just look at the 52-week range on it, even a blue chip stock, like let's say Microsoft or Amazon or whatever. I mean, the range I would see on these companies, even if I picked a company like Berkshire Hathaway, would be well beyond 10%. It would be more like 50%. And if that apartment were publicly traded, it would again have this 50% variance. So basically, in a negotiated transaction, you have an intelligent buyer most of the time. You have an intelligent buyer facing an intelligent seller, and there's price discovery, and they arrive at a price that works. In auction-driven markets, especially if there is distress, you're going to get crazy pricing sometimes. You can get crazy pricing where things are very euphoric, kind of like, Snowflake after the IPO, or Carvana after the IPO and subsequently, or you can get extremely depressed pricing because it's faceless buyers and sellers doing different things, which attenuate the ranges. So it's because of that more extreme attenuation that Guy and I are able to make a living. And I think it's a lot harder if I were to go into private equity, then you're playing other games, like you're levering up and different things like that, and putting lipstick on a pig sometimes, and so on and so forth. So I think that it's harder to do it in most of the asset classes than it is in auction-driven markets. Auction-driven markets really are a gift to investors.
So realizing these asymmetries, how do you deal with the situation if those asymmetries you might see in stocks or markets that you are not too familiar with? I'm thinking of the circle of competence theorem. Maybe so how does the situation come up? Do you then read in, or how do you educate yourself? And then how maybe has your circle of competence, where you feel comfortable, has developed over the past years?
Yeah, one doesn't need to sweat expanding the circle of competence. So I think when we are young and start out, there are relatively few things we understand. We might understand mostly brands and companies that we are consumers of. Those would probably be the most apparent and most easy to get our arms around because we've got kind of experience with them. More, other businesses which are not consumer businesses might be more difficult. But over time, it is natural, if you are reading and thinking a lot, that basically the circle is going to expand. One doesn't need to focus on expanding the circle. It'll happen organically. And but one needs to be very careful that when one is looking at something which is outside your circle, that you're very intellectually honest and taking a pass. And many times the mistake I've made is I thought I knew something and I didn't, and so that may not work out so well.
Guy, how has this developed for you? What's your take on your circle of competence and the development of this?
Before I get there, I was just coming back on one thing that I just think is important, knowing you and some of the students in St. Gallen, is that, and it's another of the many lessons that I learned from Monish, is that the reason why not working in a team works for Monish when it comes to investing is very related to the way that Monish's mind works. And it's worth saying that he was speaking, as I understand it, directly to investment decision making. There is a team around Monish. It's just that they're not very heavily involved in the investment decision making, which is, as Monish said, a dictatorship. But if you're going to send Monish an email, it's going to arrive at an assistant's desk who will take a look at it. So there are other people around Monish. And I think that the more general idea is that we need to figure out what we do best. And there are some people who will only be happy working in a team, full-time in a team. And I would argue, just speaking for myself, yes, the investment decision-making ought to be made alone, but that doesn't mean you don't get enormous amounts of support and help from other areas of your life. And so Another area that I'll come back to this, but I think that Monish has really unique insight and expertise into the extraordinary changes that are going on in India. So Julius, I'm going to plant a question with you if you decide to ask it. Monish has some real estate investments in India. I think that's public knowledge. And some unique ways in which India's only started responding in a more Singaporean or Dubai way of looking at the world and kind of leapfrogging what is happening in the way Western Europe and North America have developed, which is kind of exciting. He has more expertise, way more than I do. And so it would be a nice question to pitch to him. In terms of my circle of competence, well, first of all, I think that from your perspective, Julius, or from the perspective of a student, there's this question if you start approaching investing, which goes like, why the hell am I not Warren Buffett? Why am I not a genius at figuring out my circle of competence? And and I can spend time around somebody like Monish Pabrai saying, why the hell are you not Monish Pabrai? And sorry, just rewinding to another part of the conversation. For me, just remember that when Monish and I teamed up to bid on the launch, I'd met Monish twice. Before the launch happened, I actually flew out. No, I was on my way to Australia, and I specifically made a stop in Irvine because I thought I better get to know this guy a little bit better before the launch happens. For me, an enormous benefit of the launch was just this front row seat with Monish, and he has impregnated my thinking in so many ways. And in terms of how to live my life and how to run a business, I just want to give you one thing that kind of comes across in this conversation. Monish is completely relaxed. Why is he completely relaxed? Is because he is 100% truthful with the world. So he's not worried about how the conversation is going to unfold or what's going to happen. He doesn't even care he doesn't know what's going to happen, but it's okay because he's completely aligned with the reality of the world. He's not concerned with an external view of how people see him and how he himself feels about how he ought to be viewed. That takes away so much stress and tension, which just comes across in the conversation. When I met Monish, who I presented to the world and who I was inside was so far apart, and I got into knots. Just, I'd call Monish up every 5 minutes saying, this friend wants to share the cost of the lunch with us. I'm not sure. Do you think we should get together and ask questions? We need to prepare the questions that we ask Warren. We need to have talked about it beforehand. He's like, guys, stop it. It's going to be just fine. Just leave it alone. So that's just something that is interesting for me, that the asymmetry for me, the upside for me, which was in a certain way, if you really genuinely, if you said, would I like to have met Warren Buffett and Charlie Munger, or would I like to have met Monish Pabrai, they would have been in a certain way wasted on me. All the learning that I've had through Monish has been better for me than if I would have just met Warren and Charlie once, for example. So when it comes to circle of competence, the real question is not why am I not Warren Buffett and figuring this out so well, is just how do I figure out where I am in this moment, and how do I be brutally honest with myself about what I actually can know and do know and what I don't know, and not worry so much about where Monish's circle of competence is or where Charlie Munger's circle of competence is. I don't know if that helps you. And I think that, in my case, which has come out many times before, although I have to say, I'm not in Turkey for all sorts of reasons. We can get into it, but I have made investments in the Philippines where people tried to, which were successful. So, but in general, we joke about it. I'm willing to do sports that I could get myself killed in, like cycling and various sports like that. But I'm very, very scared around losses of money. And Monish is like very, very conservative when it comes to his physical, because that's actually more important than whether or not you've lost a little bit of money one year. But and that's also fine. So I think that the way I would define when I'm going through the world trying to figure out my circle of competence, I'm far more conservative, and I like to hang out around these, strong brands, for example. Whereas Monish, with his very unusual way of seeing things, will see something that is actually, he sees that it's within his circle of competence because he sees the whole world, including his friend Guy, just doesn't get it. And maybe the 8th time that I've been through it with him, I start understanding the way he's arrayed the facts, and it's like, actually, that makes a lot of sense. So, maybe that then the situation comes into my circle of competence because I've learned his thinking. But my point to you is, when you ask that question and when you ask yourselves, the group who are watching this, is this within my circle of competence? Don't have a voice that's sitting there saying, you idiot, you're not Warren Buffett, you're not Charlie Munger, you don't have the insights that Monish Pabrai has. That's the least important thing. I'll stop there. I don't know if that's helpful. I hope it is. Back to you, Julius.
Well, I think it surely is a very mindset to be aspired. The mindset you, Monish, have developed. Is that something, as I mentioned, that develops over time, which comes with more confidence with oneself, or how was this achieved to be so truthful and relaxed with the place you are in?
Well, I mean, I think a lot of it is genetic. I think there's traits we're born with. There's some traits we can pick up, but I don't think you're going to take some hyperactive trader and convert them into long-term value investors and have them be happy doing that. So to some extent, some of these are inborn traits. Some can be learned, but you're going to have difficulty if you're trying to do something which is very far away from what your natural tendency or bias is. So it's really important to know yourself.
I've been around Monish when he's been with people who are kind of like, in a very mild and perhaps even subtle way, misrepresenting reality in one way or another. And, you can practically, maybe it's exaggeration to say there's a physical reaction in Monish, but he reacts to it very, very fast in a way that I think that when I first met Monish, I kind of like, it was surprising to me. And I think I've now gotten better, but I suspect that reaction to people who are not aligned. Well, I'm curious. I'll ask you the question, Monish. Did you always have that, or did it grow with time?
No, alignment actually came about. I would say the seminal thing that happened to me was I read this book, Power versus Force, and basically what that book showed is that you can't really get away with lying. So basically, if you lie to someone and you think they're not really going to know, there are things going on with your kind of body language and other things which eventually will make that apparent. So actually, there's on the other hand, if you're saying the truth all the time, you're going to, in the terms of the book, make people go stronger around you, and they'll want to hang out with you. So we want to hang out around the Dalai Lama, and we don't want to hang out with used car dealers. And that has to do with the truth. And when I read that book, I wasn't a kind of a dishonest, deceitful person, but what it helped me do is get rid of the small lies, get rid of the white lies, and that helped a lot. I mean, I think that getting closer to pure candor and pure truth is going to help you a lot in life in terms of being trustable, and being trusted is one of the most important things.
And it's got these extra benefits. So one thing that I've learned from Monish, and I don't know where you got this from, is Monish, is that 99% truthful gets you maybe half the way. It's that last 1% that gets you the full way. But there's something else, and I've seen this in two friendships that Monish has that I've observed, in which one of the reasons why they want Monish around is they know he isn't going to sugarcoat the truth around them. They're going to get an honest reaction from him. John Elkann talks about truth tellers. Get yourself around truth tellers. And extraordinary benefits that, what's amazing is that that's one of the books that Monish brought up in the first time I met him. And I learned so much from that book, but I don't think I've applied the lessons as well as Monish has. I don't think I've applied them in the same 100% way that Monish has. And it's hard not to want to sort of misrepresent in ways that you feel like won't make a difference, and actually is just maybe flattery or telling somebody that they look better than they do, and it's that last sort of, and to do it automatically without even thinking about it, where that's where you live, that's the place where you live. So
Surely, and since I am myself being educated so well here, Monish, maybe let's talk about the Dakshana Foundation, which is involved in alleviating poverty through education, which I personally see as a great and the best cause of a foundation to have, to work through education. Thinking of education systems worldwide right now, obviously we're here at a university. What's your take and perspective on the current education system? Is there something to be improved, especially focusing, since you're focusing on it in your foundation?
Well, I mean, I think that when I look back at my undergraduate engineering degree, there are probably no more than 2 or 3 courses that had a long-term impact. I mean, the one course which was an elective course that I just took kind of without really having much thought, which has helped me a lot, was a course on public speaking, and that was, I would have never guessed that would have much impact, but it did. So I think that the way the world works is employers are looking for shortcuts, and one of the shortcuts that employers take is that if you are graduating from an elite institution, some great employers are going to come over to basically interview you and try to hire you. So it's not so much what you learned at that institution. It's just that institution opens doors that would not be open otherwise. So I think in general, uh, higher education and such has lots of inefficiency. I mean, if we go to a top end school, and this is just not just my experience, but most people's experiences, they probably wouldn't be more than a couple of professors or teachers or courses that had some impact long term on them. And so what that means is that there's a lot of low hanging fruit over there. I mean, if I look at the IITs, which is where we send a lot of our kids, the IITs have an incredible incoming class selection filter. It's probably the best incoming class selection filter amongst undergraduate institutions anywhere in the world. It's better than any other university because it's so objective. There's no legacy and there's no subjective stuff which you're a big donor or whatever else. But so it's got great talent coming in. It has very mediocre professors. In some cases, I would say pathetic professors. And it has great talent going out. And again, the same thing. If you talk to IITians about what they learned at IIT that was so instrumental, they'd kind of be scratching their head. Oh, I had this one great professor, or I had this one great class, or something like that. But basically, what it does is that these guys have so much horsepower, and they also combine that with an ability to work hard. So horsepower with ability to work hard, that these great employers show up at IIT to recruit, and then these people end up at Amazon or Salesforce or Google or whatever, and they do really well. But it's not because of the IIT education; it's because of the filter. And so I feel that when people are spending 2 years or 4 years at these great institutions, they should get more than a couple of courses out of it. So there's a lot that can improve, I think.
Surely, since I now had the fortune to ask you so many questions, we want to get the audience involved now, and we'll be taking questions. You can post them in the chat, and maybe you'll be picked, or there's one already. We have someone asking in the chat. You have both have quite concentrated portfolios. Does this also mean that you want your investments to be uncorrelated? And if you have to choose between two rather correlated stocks, what are your criteria? This is not only limited to you, Monish. So, Guy, if you
well, I would just say that normally when I make investments in the fund, in fact I've never invested more than 10% of assets in any one bet. So typically, ideally, it's kind of a 10 by 10 portfolio. There was a very good investor in India who passed away recently, Rakesh Jhunjhunwala, and he never managed money, outside money, and he had probably less than $500 to his name when he started his career. He didn't live that long. Actually, died in his early 60s. And when he passed away, his net worth was north of 6 or 7 billion. No fees. These are all organic, and he didn't run companies. These are all passive investments. But half that money was from one company. So he made a 4% bet a few decades ago in a company called Titan Industries in India, which ended up becoming more than half his portfolio. And Titan has done extremely well over the years, going to keep doing well. So if you think of someone like Rakesh's portfolio, let's say the other 96% of the portfolio went to zero, and he just hung on to his Titan, well, he still end up with like 3 billion or something, and so we start out, I would say, not that concentrated. But if the job is done right, you would end up very concentrated. So one of the things I always kind of scratch my head about is that these very smart investors would buy MasterCard after the IPO, and they might be more diversified than me. Maybe they might have 20 positions, which is fine, no problem. And so MasterCard is like a 5% position. And then it does really well, and it becomes a 25% position or a 30% position because it's done so much better than everything else. And like Jack Nicholson said, they can't handle the truth. and in some cases, their grandmothers took away certain body parts when they were 13. And so they're done. Well, it gets to 15% and they trim. It gets to 17, they trim again. And it never gets to even 20%, right? And so to me, I really scratch my head about that. So yes, you get a diversified portfolio, but you're cutting the flowers and watering the weeds. And that's not what Rakesh Jhunjhunwala did, and that's not what Warren Buffett did. So I think that if an investment manager has done the job right, they're going to end up with 80-90% of their net worth in one stock. And the way they should think about that stock. So if we think about the Walton family and their ownership of Walmart. So Sam Walton passed away a long time ago. There are no Waltons running Walmart. There might be a couple of them on the board, but they really don't have much influence about the way Walmart runs. But almost all the Waltons are extremely concentrated with 90% or more of their wealth in just one stock, right? So you don't need to be a founder or a founding family to have that concentration. So my friend Nick Sleep, for example, hung up his boots. He had 3 stocks, and one stock, Amazon, became 80%. Because it did so well and the other 2 weren't slouches, but it did better than Berkshire and Costco. And the way to think about Amazon 80% is the way the Walton family thinks about Walmart stock when it's 80 or 90%, which is you are effectively like the founding family, and it's a great business, and you just leave it alone. But this is hard. This is hard for most people to do. And I think I have a lot of respect for Rakesh because of what he was able to do on that front.
So one of my painful episodes is that I owned one of those called Crizzle. I had met Monish maybe once, not even, and I go to India for the first time. I remember, Monish, you gave me the book by Dalrymple, City of Jinns, to read. I don't know if you know that, because Jhunjhunwala was a significant shareholder of Crizzle, and so I went to his office to try and
Crizzle
meet
is
him.
Crizzle is like the Moody's of India.
Forgive me. This is it was the first stock. I've only owned, I think, 3 stocks in India. I was looking for credit rating agencies around the world, found Crizzle, bought shares in it, went to visit made significant return on my investment, but then convinced myself that I not only had to trim the flowers, I pulled them out and threw them on the dustbin. And that would have had a very significant impact on my net worth and the net worth of my investors if I'd stuck with it. It's probably up 50 or 100 times since I sold it. But Monish, so I go visit Jhunjhunwala's office somewhere on that kind of peninsula that is Mumbai, and there's just there's place for 20 people there, and Jhunjhunwala's office is empty, and there's one guy. There's not a lock on the door even, it feels to me. I kind of just walk in, and there's a guy who looks at me and says he wonders what I'm there for. That was it. That was his whole office, and just funny. Yeah, sorry, just a reminiscence.
Yeah, and the thing is that we are old too soon and wise too late. There are so many great businesses that I sold, which I have a very deep regrets about. I had ownership of something like 1% of Ferrari in our funds. What could be better than that? And this idiot sold it. And the idiot's friend is smarter than him, and he's kept it, which is wonderful.
But only half as smart, because I sold half of it just as we went into lockdown. Monish doesn't let me forget that, by the way.
At least not the whole bunch of flowers were thrown away like me. At least he kept some of them. But the thing is that with some luck, I may have another 32 years or so on planet Earth, and so there is still time to apply the lessons that took a few decades to learn. But I think one of the big lessons is that when you find yourself in the great position of fractional ownership of a great business, you don't really try to do things like cute things like figure out intrinsic value, etc. When in 1972, Buffett and Munger, they always say that they have a perspective on what the intrinsic value of Berkshire Hathaway is. And they say if both of them wrote down their numbers, they wouldn't be the same, but they would be in the ballpark. And I actually disagree with both of them. So, in the mid 70s, Berkshire stock was $40 a share, which is now over $400,000. It's a 10,000x. What was the intrinsic value of Berkshire in the early 70s? The answer is that it was a really large number. We don't know what that number was, but we know it was a very large number. Now you could calculate book value and you could give it some multiple on book value, but what you're not taking into account is what if this great compounder of capital is sitting at the helm of this company for 50 years after that? What happens then? And so I think in a lot of great businesses, we can get to liquidation value. We can get to floor values relatively easily. We really cannot get to intrinsic value. Because if they keep going and you go 10, 20, 30 years, what does that look like? I have no idea what that looks like, but what you need to do is just stay on for the ride.
Great. Yes, we have a lot of people awaiting answers in the chat. How can students design their career to have a fund like Guy and Monish and be successful with it? So how did you design your fund, and what's the take from it for students?
Well, so the simplest way to do that is, I'll just tell you my journey, is that you start by, whatever small amount of money you have, you start by building a track record. So you open a brokerage account and you start buying stocks. And the amounts aren't that important. What is important is that you don't pay your grocery bills out of that account. Keep it so that you can later have that record audited. If you've done well with that account where you've done significantly above market, then you can go to friends, family, and fools, especially the fools, and see if some of them will give you some money to add to that kitty. And Buffett says that if you are even a slightly above average investor, they will swim to you in the middle of the Atlantic in shark infested waters to invest with you. So if you do a good job for the friends, family, and fools, there will be more people who will show up to that party, and it'll just keep going. So basically, the investment business is really simple. Do well for yourself, do well for your friends and family, and then the world's going to show up.
Julius, I just want to go to something even more basic. So I have not had personal interactions other than maybe one book to Charlie Munger, other than a book that I sent him, and he sent me a nice note back. But my experiences around Monish and around Warren is that it's kind of like the way they live their lives is that they're constantly leaving so much more on the table than they take. And it's in 1,000 different ways. I mean, the funny thing is when Monish developed this friendship with Charlie, he bent over backwards to try and get me into the same relationship with Charlie. It was like he kind of drags me over at one of these brunches. Now sit down and talk to Charlie. So, and he did that. He wasn't, that's just the way he is. And in 1,000 other ways. And Warren, the same thing. And when I realized that he's kind of doing small kindnesses for me, Mr. Guy Spear, who's such a nothing in his life, I just imagine how many other people he's doing it for. So I would just step back and say, yes, a very nice outcome would be able to run a fund like Pabrai Funds or Aquamarine Fund. But there's a much more basic mode of behavior to get to joy. And it's living one's life, constantly making sure that you leave something on the table, that you gave more than you took, and that you're somebody that people want to be around because good things happen when they're around you. And one of the outcomes might be running a fund, because if you try and start running a fund and you don't have that modus operandi, you're unlikely, I think, to make a big success of it over the long run. So underlying all of that is a far more basic orientation. And I think that the reason why I just get so excited about that is that it's applicable to everyone. And I dove into investing with the desire to get rich, but I didn't realize that I was going to learn some profound wisdom about how to live my life. And it's strange because once I understood it, I saw it in some people, and some people just don't have it. And the book I'm referring to here really is Grant, Give and Take. And you just really want to identify the people who are givers, not matchers or takers, and you want to become yourself somebody who's a giver. And I think that leads you to the promised land, whether it's running a fund or something else.
Definitely, it all reminds me of the concept of compounding goodwill, and this then actually leading to payoff, which was not intended to be reached, but then reached. I believe we have time for one last question. Considering the initiation phase of a young investor, what would be the mental model required to move on more easily from bad decision taken previously?
Well, Charlie Munger would say that you want to learn, but not learn too much. So this is a business where the best investor is going to be wrong 1 out of 3 times. And most likely for the mere mortals amongst us like me, we're probably going to be wrong half the time. But like we saw in the Jhunjhunwala example, he only needed to be right on 4% of the portfolio and didn't matter about the rest. So mistakes are very much a part of the landscape. We're going to make a lot of mistakes. And I think you need to be intellectually honest with yourself, and you need to move on. You don't need to make the money back the same way you lost it. So once you realize that you've made a bet which has led to a loss of capital, and you have a better understanding of the business and such, it may make sense to just move on and learn what you can from that experience. Don't learn too much, and keep going from there.
I couldn't say it better, Julius.
I think it's a great note to end our incredibly valuable session today. So thank you very much, both Monish and Guy, for spending the hour with us. Thank you in the name of the Helvetian Investment Club and the whole university. For everybody who wants to rewatch this stream, it will be available on YouTube as well as LinkedIn. So thank you, and see you soon, hopefully.
Now, Julius, hold on a second. That's very nice but you didn't give us the chance to thank you. And I get the chance to say, Monish, I know it's cold in Switzerland, but in summertime, it's really beautiful, first of all. Second of all, there really are a special set of students at St. Gallen. I was so impressed there and unusual minds. And it's a really stark campus. If you think that Zurich is stark, think of St. Gallen, like Eastern Switzerland, it gets even more stark. And I just wanted to thank you. You actually, I would really say that I went out and gave a talk. I don't remember how long it was, but it was kind of inspiring to be amongst them. And so it's lovely to do this streaming. But Julius, I still have this ambition that we will get Monish to St. Gallen at some point.
Well, I have to say, Julius, that when Guy asked me to jump, I just say how high, and so he told me you have to do this talk with St. Gallen, and I am glad I said yes, and I really enjoyed the session, and I hope we can repeat this again.
Thank you very much. Yes. In terms of how high, let's aim for the stars, and hopefully we'll have you here on campus soon. So thank you again, and now let's end this session. So see you soon, and thank you very much for being with us.